They did it. The Fed actually did it. They have finally cut interest rates for the first time since, what, 2020? But what does this mean for the stock market? What does it mean for the economy? And is there anything we should be concerned about moving forward? And what should we do as investors and consumers moving forward? Let's go ahead and break it down. So I am going to give you the entire rundown of everything you need to know about interest rates, what the Fed did today, why it's important, and everything in between. And I'm going to do it in less than 10 minutes. I'm going to do it in a way that you can actually digest and understand. All right. So we're going to start off with how we got here, what happened today, why it's important, what you should do as an investor. So first, let's start off with who the Fed is, set the table, and then talk about like how we got here to begin with. Now, the Fed is the central bank. They have what is called a dual mandate. They got two jobs, okay? Their main job is to keep prices stable and to keep full employment. Full employment meaning everybody who wants a job can get a job, that is keeping the unemployment rate low. Low is, single digit unemployment, but really we're talking, 4-ish%, 5% unemployment. And right now unemployment is relatively low. They've been pretty good at that. Prices and inflation, that's been the hassle, right? And that is what they're trying to do. Keep prices stable, keep unemployment low. Now, one of the ways they do this is by adjusting interest rates. This is the rate that we use to buy a house, buy a car. And this is the same rate that companies use to borrow money to hire people, to get more equipment, to do a bunch of things. And that is the rate that really runs the world, that we found out at the end of the day. So if you were looking to buy a house in the last 3 or 4 years, you found out that mortgage rates were a lot more expensive. That's because the Fed raised interest rates. How do we get there? That was all because of the pandemic. And what generally happens, it happened in 2008, and anytime that the economy grinds to a halt, they say, look, we are going to cut rates to near zero. They cut rates when the economy slows down to encourage people to borrow, to encourage people to spend. Why do they do that? That's because more than half of our economic growth is based on you and the way that you spend your money here in the United States. So anytime they can get people to get out their house and spend money, they make money cheap. Making money cheap is making interest rates very low. So when you can get free money or cheap money, get a loan for very little, that is what they try to do. For example, my mortgage is just under 3%. Mortgage rates today are not 3%. They are, right now they're closer to 5-ish, but at one point they were like 7%. That is very expensive and can double other people's mortgage prices for the exact same house. So if my mortgage is $2,000 for the exact same price, or exact same house rather, other people can be $3,500 for the exact same house. That says to you, I don't want to buy that house no more, right? And that discourages spending. So that is what they do. Cut rates to encourage people to spend, and then raise rates to slow down people from spending. In what world would they slow down people from spending? That is when they raise rates to discourage people to spend, when they see inflation going too fast and too high. That is what they try to do, which is what we saw in 2022 and what we have seen for the last 2.5 years or so. Prices shot up. A part of this was also due to the pandemic. If you guys remember, we were all there, right? We were all locked up. A lot of people got stimulus checks. A lot of people were saving money because we weren't going on vacation, weren't paying student loans, weren't commuting back and forth to work, and we had a lot of money just stored up. So when we were able to go outside, spend money, and do all that stuff, we had records amounts of savings. We had talked about it here on the channel, and people were spending like crazy. We also had those supply chain shortages. We had way too much money and there weren't enough stuff for people to buy, and some companies were greedy and jacked up prices. So the Fed had one of the only weapons they could use, and that was to jack up interest rates to slow down people from spending. Did it work? That's kind of yes and a no to a degree. Inflation did go from a high of 9%, it's like a 30-year high, and did come down to 3-4-ish%, depending on what month you did look. So yeah, it came down. Is it still higher than what most of us like? Yeah, so it sort of worked, but also if company is greedy, then the company's gonna be greedy. It is what it is, right? So there's a catch-22 there to a degree. So that is how we got there. But now the Fed has said, all right, it's about time for us to cut rates. Now, they are doing this for a few reasons, one of which is unemployment has ticked up just a bit, and we feel that we are at a point where things have slowed down and gotten to a point where we can reduce and get the economy juiced and moving just a bit. But the interesting thing is, normally when they were increasing interest rates, they were doing so by 0.25%, that is 0.25%, and they just inch up these interest rates just a bit. Doing so has helped you in your savings rates. We have talked about bonds. People were talking about interest protected bonds, all of these things 2 and 3 years ago, and now those things are going to move in reverse order. You are likely going to get an email here in about 3 weeks or so, if you haven't gotten one already, about how your interest rate on your savings account is about to drop. That's not the worst thing in the world, but those things are about to move in reverse order. So you are going to see a lower rate on your savings account, but the market generally, not all the time, but generally does start to go up. And the reason why that is the case is because, again, a lot of these companies are now able to borrow and hire more at a cheaper rate. So there is kind of a balance there, if you will. Your credit cards generally work on the same system, if you will. You should not carry a balance, first off, okay? We only carry imbalances on our credit cards whenever possible. So to me, it don't matter what the interest rate is, okay? Because I pay that thing off, okay? I don't know what I pay because I pay it off. It's at 0 before they try and hit me, okay? But generally, let's say if it's at 20%, which is high, or 25% or whatever it is, as the Fed changes interest rates and they reduce it, so too does the credit card interest rate and vice versa. So again, they cut interest rates by 50, right? So 0.50%, which is mildly aggressive. So again, savings accounts rates are going to creep down just a bit. Credit card rates are going to creep down just a bit. Perhaps mortgage rates could creep down a bit, and this could be a good time to start searching for a home if you were in the market to buy. But there are at least 2 concerns that you do want to have on your radar. Before we get to those concerns, don't forget that I do have a free resource on how you can start to buy your first stock. It's a free PDF. You can get that right here. I take you through the entire investing process, including the apps you need to use, the research techniques, and the things that you need to know to buy your first stock. So make sure that you get it right here at the link below. It's also in the description below as well. So the first thing, let's start off with the house piece. I'm not entirely sure if this is going to be the first time that interest rates are going to fall. So you don't want to, go for the first discount that you see. And we have started to see mortgage rates do fall for quite a bit. It also doesn't mean that housing prices are going to fall across the board. It is still a supply and demand business. Supply ain't changed. Okay, unfortunately, we need to buy or create more housing across the board. We need to increase supply. That's what we need to do just across the board. So, yes, the rate may come down. Demand is going to go up because you're going to have more people flooding the market. But if it's still only one house for us to buy, and now you have, instead of 100 buyers, you got 500, that price is still going to be up. So there's that. So that I wouldn't just flood the market now. I might be a little bit more patient, continue to save, and strike at what you think is the right time. So don't be forced into it because you feel like you have to because they cut rates today. Okay, so be patient. Don't jump in it today just because they cut rates today. Be patient, shoot for the right opportunity. Because again, I don't think this is going to be the first quote unquote discount or the first time they're going to cut rates. We'll see if that's going to be the case, because we did expect this to be, I think, at least 2 cuts initially in 2024, and so far we only got 1, and it's already mid-September. So we'll see what is going to happen with more rate cuts, but I don't think it's going to be the only one that we're going to see, for the next 2 years. Okay, so be patient there, but again, don't be overly optimistic that everything is going to go on sale either. So have a measured approach there. The next thing is the whole recession thing. Now, By definition, we have not been in a recession. The National Bureau of Economic Research is the one who officially declared whether or not there is a recession. We did not see that. The stock market didn't say that, nor did the stock market actually define whether or not we are in a recession. But people were yelling recession left and right, and it never actually came. Hooray! I mean, that is what I would prefer, us not being in a recession, right? Unemployment never actually fell off. Hooray, right? Which is what we want. Now, the interesting thing is, again, people were calling for it. It felt like, at least on social media, from what I saw, people were just, it was a vibe session, is what it felt like. It was a recession of feelings, is what it felt like. Now, inflation was high, and we didn't like paying higher prices. And I would still argue I don't like paying a lot of the prices that I'm seeing, but higher prices is not a recession. That's not the definition of a recession. Now, there was a point where we did have 2 back-to-back quarters of negative GDP growth. That means the economy did shrink slightly 2 quarters in a row, which is the technical definition of a recession. We did a whole video about that as well. However, also in that same economic textbook in which I had to get my degree, there is also a line that talks about the other things that need to be officially declared a recession. Those things did not happen. That also includes unemployment, among other factors, and the National Bureau of Economic Research declaring it as such. And they did not. So, we did not have a recession. Now, here's the issue with that. One of the things that we were afraid of is that the Fed was going to raise interest rates so high it was going to push us into a recession. That's what we saw in like the late 1970s and 1980s. They raised it too high, pushes it into recession, bad things happened. Okay? And they did that because they had very high inflation back then. They were very aggressive in fighting inflation. So now we have a similar problem where the Fed was slowly but surely increasing interest rates. We saw banks collapse. That did happen about a year ago, and that's what we were trying to fight against, right? It was like, y'all are raising interest rates very aggressively. I see banks collapsing. It might be a recession. Can y'all stop doing that? Okay? Well, we didn't run into a recession, and now they're starting to cut rates. Well, what happens if, okay, because you see it, okay, gas prices have come down a bit, but you see it, prices aren't great. They ain't what they used to be, okay? Now, let's say they cut rates and inflation comes back. And if inflation comes back, what if they make a mistake and we go into a recession because of that and they get too aggressive and push rates higher than what they should be? What if that occurs? Is that a risk? I don't know. What if this is a wrong move? I don't know. That is a question, and that's something the Fed is going to have to contend with, something the stock market is going to have to contend with, and something that the economy is going to have to contend with as well. If you'd asked me to put a number on it, on whether or not cutting rates is going to push us into recession, I would say it was low. I don't know if there's ever been a time in history, and I really have to think about this. We have to think about this, but I can't remember a time where cutting interest rates has forced the economy into a recession. I can think of time where raising them has pushed us into a recession, but I can't really think of cutting them pushed us into a recession. If you cut them, you could start to see inflation come back up because people could spend out of control, and you could start to see us pushing for more goods, and more money chasing fewer goods is the definition of inflation in some ways. But I would argue that we don't have those supply chain shortages that we did. And if you want to walk into almost any store and buy anything that you want to, that item is probably going to be there. And if you don't want to buy something, you don't have to, and that company will respond and probably lower prices. We have seen this at companies like Target and Walmart where they actually cut back on prices as well. So I think companies are a bit responsive if it's not like a monopoly or anything, where they're going to look and say, you know what? They're not buying this. Let us respond. So I don't think we're in the exact same place as we were in 2021 or early 2022. And I think it's okay. I think it's okay to cut interest rates. I'm also not, a chief economist. I got an econ degree. I'm not a chief economist. But that is my take on it. If you ask me, was it the right move? I'm kind of in the middle. I'm kind of agnostic. I don't have the biggest view of it all, but as an investor, I do think this is a stay put moment because we've had a very neutral tone on this entire thing. We still own tech. I still think it makes sense to own some tech. We still own energy stocks. Last I checked, we're still in the fall, moving into winter. Still makes sense to own energy stocks. That ain't changed, right? So a lot of what to own from a stock market perspective, index bonds and everything in between, a lot of that has not changed. And also the reason why a lot of this hasn't changed is you knew this was coming. We've all talked about this coming, especially if you're subscribed, for a number of weeks and months at this point. And if you have not, this is your opportunity to do so. This should not be a shock to anybody who has subscribed to this channel or who has followed the stock market for any length of time this year. I would say that the only thing that was shocking, or at least news to me, was the fact that it was 0.5% versus 0.25%. I found that out maybe 2 or 3 days ago, but that's really it. That's the biggest takeaway. But I would say stay focused. Doesn't really mean that much from an investing perspective. It will start to shift what you do with your cash short term, but not today, not tomorrow. I do think over the next 6 to 8 months, we'll start to talk about strategies around what the Fed continues to do and what do we do with our cash. We've talked about some of the best bank accounts and what to do with your money there, but we may start to switch that around, right? What are the best bank accounts going to be? Because that money still matters, and we still want to make sure that it grows as well. But if you want to know some other areas to take advantage of your money, what are some of the best stocks to still invest in right now? If you want to know those areas and what to do with your cash, you want to check out this video right here.